What's up, everybody? This is Joey Somerville, aka Papa J. I have one question for you. When the lights go out, are you ready?
Hey, good afternoon. It's Ronco Johnson. This is when the lights go out. Are you ready? Good afternoon. It's Lifestyle Focus Friday. For all my Lifestyle Focus Friday community members, hello. Hey, well, we're going to get into it today. Do you have any family members that you don't know, like the pillowcase or under the bed, or maybe even a pickle jar out in the backyard? Well, today, creating an emergency fund using life insurance. That's right. We're going to be talking about using life insurance as an emergency fund. Why would we even bring this topic up? But we're going to roll right into it. And thank you guys for joining us. And we're live. It is Lifestyle Focus Friday, so we don't want to forget about that. Thank you guys for joining us. And, if you have an opportunity to say hello to a friend, just remind them that Lifestyle Focus Friday is every Friday on all your streaming platforms. And today's show, we are definitely wanting to talk about how to create an emergency fund using life insurance. But before we get into it, some housekeeping. All I want you to do is remember, don't forget to subscribe. Don't forget to like our button below. Hit the notification bell, if you will. Build our community and our focus of what we're trying to do in the community, the masses, and educate the culture. So we're going to get into it. We'll do it every Friday right here on YouTube, Facebook, LinkedIn, Twitter. You name it. But once again, we thank you for joining us. And we're gonna talk to you about saving money and what the wealthy people do. What wealthy people do. I was sharing this, and I was talking about how wealthy people put their money together. And before I get into it, I had a client that stopped in, and we were doing a one-on-one session, and she couldn't quite track where her money was going. She had two separate accounts, one for savings and one for her bill account, and we couldn't quite track it. But after we went through the information, and we figured out that the money that she had going into one place was being used, if you will, in the bill account. And when she thinks she's saving, she's not. And that was putting her behind about $1,000 a month, or close to $1,000 a month. So when we started to investigate a little bit further of when you're saving money and how you're saving, Ronco, my parents didn't have saving habits. I'm just doing the best I can with the knowledge that I know how to do. And I think that's the case for most of us out there. At that point, my light bulb came on as well, and I'm realizing, hey, she's not the only one that's had a lights out. We're here for, and something as basic as not having the information has led me to be here with you. And it's a blessing to be in this situation where we can talk about these matters in a private setting, and everybody wins. So I see some of my viewers showing up. Thank you for joining us. This is When the Lights Go Out. Are you ready? And it's Lifestyle Focus Friday. I'm your host, Ronco Johnson, keeping you company this evening. So thank you very much for joining us. But we're about this again. Don't forget to like, subscribe, share, and click that notification bell down at the bottom. This information today is brought to you by L.R. Johnson and Associates. I will tell you, they do a good job. Their volunteers are doing a good job of putting financial education into the atmosphere in a place near you. And thank you all for wanting to come in and talk to us about becoming a member of our Lifestyle Focus team. You can join our Lifestyle Focus team online at lifestylefocuswealth.com. It's really easy to get involved. It's only as low as $16 a month if you want to join. And you get opportunities to speak with me, one-on-one sessions, and also get to know the other members and all the other perks and surprises that they have. It's a wonderful opportunity to talk to people in the community that are already doing these things and having healthy money habits, healthy lifestyle money habits, if you will. So we would like to see you there. We would love to see you there. Okay? Well, let's get right into it. Today we're talking about having an emergency fund. An emergency fund that's created and used with life insurance. You know, you got so many other places that you can save money, right? But today I'm hopeful that we educate you on just another opportunity and why it's effective to use this particular tool, if you will. This particular financial tool that many people don't know about. You some of the secrets. I'm going to share with you some of the secrets. I'm going to let it all out here in just a moment. So let's talk about how we're going to create it. How to create an emergency fund. Well, before I get into how we create this emergency fund, we want to know a little bit about, how is a person going to shape the idea of having this emergency fund, right? Can you imagine now? Tell me, what if you could use your capital without interrupting the compounding interest effect of your money forever? I need you to hear me. Suppose you could do that. If you could do that, how far ahead would you be? How far ahead would you be? I have to say, I think you'd be further ahead. I want to show to you why. I want to show you why. Well, first we were talking about having this financial tool that can compound your money without affecting your growth. Well, it's safe to say that the banks have been knowing how to do this for a while. You can see here on this chart, these are banks ranked by life insurance assets. And some of your favorite banks that you probably bank with right now. And you can find this information at the usbanklocations.com. And it shares with you the assets of life insurance owned by these banks. Yes, that is not a small number. That's $24 billion in assets held by banks because they know something that you just don't. They know that these banks know that they can position dollars and assets in a way that will continue to grow while the money's in use, while they loan it out to you in cars, loans, student loans, commercial loans, whatever else out there. They're loaning this money out there to you, and then you earn a very little small amount of money from the bank. But what if I were to tell you, what if I could tell you that you could have this situation on your own? Well, first of all, we got to understand what the bank controls. The bank controls everything. A bank owner controls everything. And those of you that have worked with us before, that's been part of this broadcast, Lifestyle Focused Wealth, we talk about the value of insurance and what it brings to us, right? We talk about the controls that we have. Well, the banks know it. Would you rather be the banker or would you rather be the person taking out a loan? Most people would want to be the banker. Why? Because the banker controls everything. The banker has access to your capital. And the owner of that bank has the ability to profit from the access of the capital. So if the banks are able to do this, and it was one small financial tool that allowed you to do the very same, I think you would probably want that tool for yourself. So that's what we call life insurance. But first, let's take a look at what banks do before we even get into the emergency fund. See, when you receive money and from your income or your salary, this is how the bank processes your money. Let's just hypothetically say you had $100,000 go in to your bank. And we're going to be modest and give the bank 4% on your money, which we know that's not happening. It hasn't been over a few percent in a very long time. So what happens with the $100,000 that you put into the bank? The bank immediately loans it out and increases and charges a interest rate on home mortgages, auto loans, commercial real estate, construction loans, equipment loans, and then lines of credit. So if you add up all that together, 5%, 8%, 6%, 8%, 8%, and then another 5%, you will see that the bank is profiting almost 1,000% on your money. Just because as the money comes in, they're loaning it out. And then also where they're positioning the money while it's in their possession. Where are you going with this, Ronco? Where are you going with it? Well, suppose I were to tell you, first of all, we got to look at the principles of wealth, right? Those of you that have been with us before, we've talked about the good book, The Richest Man in Babylon, which I think is a great book for you guys beginning and helping you get started and manage where you're going to put your operating money, right? The Richest Man in Babylon describes having the first 10% of your money go to you, and then 20% to your debts, and then 70% for you to live off of, right? So you got the 10, 20, 70 rule. That's just for the normal person. But once you've paid off your debt, now you have 30% that needs to go into you. 30% needs to go into you first, 70% into your lifestyle. And when I say lifestyle, I am talking about paying your mortgage, tithes and offering. All that stuff comes from the 70%. That first 10% and that 20% must go to you first and to your debt second. If you're well over 20% in debt, then you know that you're overextended. So we need to get it back down and in control. This is important because we want our emergency fund to show up. But if we're spending the assets, we're spending the cash, we don't have an emergency fund. Make sense? We don't have an emergency fund. In that case, we have to do a few different things. We have to shrink our debt. And then we have to start taking advantage of these other opportunities, such as tax deferred growth on our money, right? Well, I want to pull this chart back up. We want your mindset now, just your mindset, to work just like this. With this chart right here, it shows us that the bank process is to bring the money in to your bank. And then you loan the money out to everybody else and you earn an interest rate. I call that The cash, the $100,000 that you see in this chart, is the tool. This part right here for us is the tool. It's just like the hammer and the nail and some wood. Without this tool, you can't build a house, a chair, a table. You can do so many things with this tool. In other words, this tool is basically creating an opportunity for us to have home loans, mortgage loans, commercial loans, and so forth, right? So we want to make sure that we understand that piece of the puzzle first and foremost. The second thing I want you to understand, this property called life insurance, a lot of people don't know what I mean by that. How does that really work? Well, here's a small example of how it works. First of all, there's an exponential curve that we're working on. This is not term life insurance. And term life, that's not the conversation that we're having on this particular episode. But for those of you that have permanent insurance, whether it's an IUL, whole life, both of those have that feature. We call it permanent insurance. But today, I'm going to talk about my preferred is whole life insurance. And see, the reason why dividend participating whole life insurance is important because there is and you share with those that are in a mutually held company. Well, let's talk about that for a second. That exponential curve that you see on your screen right now, this is what happens over a period of time where the accumulation of dividends begins to increase on a rapid level. Your advisors out there may not be very familiar with this. So you have to have your policies designed a very special way. The design, engineering, and the knowledge of your expert that you talk to, it all plays a factor in this. So don't let this opportunity to build on your money when you already have the product, but it may not be designed properly. So you may want to get with your advisor or give us a contact call over here at Lifestyle Focus Wealth, and we will be glad to talk to you. Usually what happens after this period of time, the performance of the premiums that you've paid into your insurance, it's going to continue to grow. It's going to outpace what you've paid into your plan. So that exponential curve of savings continues to ramp up. So if I give you an example, if a mother had a policy, let's just say it was $100. A lot of people don't know that if it was structured properly and designed properly and engineered properly, that you can have it where you have a savings vehicle on top of the policy. And let's just say mom wanted to save $500 for a rainy day. She has a couple of options. She takes that $500 and sticks it under a mattress, in a pillowcase, in a pickle jar. I don't know, but it's somewhere that's not growing any interest. Well, the money that you have, remember, every day the value of your money goes down. Every day the value of our money goes down. Why? Because our economy is printing more money. Our government's printing more money. The more money we print, the more it goes down. So why don't we take advantage of leveraging our capital in such a way that we're always taking advantage of some growth? And that makes perfect sense, right? That would make perfect sense to me. Once again, I want to thank you guys for stopping in and joining us. And if you need an opportunity to schedule some one-on-one time with me to talk about this a little bit further, you can definitely do so at lifestylefocuswealth.com. Just go there and click the button and schedule some time, because these are some of the secrets that wealthy people do. Okay, I am sharing it with you today. I want to try to take my time and share it with you. So if you have any questions, you can touch base with us there, and definitely we will get to you on that. So let's get back to you about this exponential curve. Can you understand this? What if I were to tell you that we want you to think about financing every purchase that you make? Every purchase that you make, meaning you finance every purchase. Not financed with someone else. You would have been earning otherwise when you pay cash. In other words, if you went Christmas shopping and you used the money in your pocket, that money is going to obviously purchase an item. It's absolutely out of your hands. There's nothing you can do with that. However, use your emergency cash. And for any reason that I'm speaking of. Hypothetically, let's just say you put your money through this financial tool first. Well, starts to play into effect. Why? Because the insurance policy actually allows your money to compound and grow with no interest. So if I could put that extra $500, instead of putting it in a pillow, under my bed, or wherever else they will put it, I'm going to recommend policy into the savings portion. That is called a LPUA, or paid up additions. That's what they call it. Many companies got a different name for it. But this paid up additions allows the policy to do two things. It increases the cash value and it increases the death benefit on every time we make these overfunded deposits to your plan. Okay? Do you have access to it? You have absolutely all access. There is no one in between you and your money. I said it. There's no one in between you and your money. Give you an example. And you are basically asking for approval if you can use to do this. Once the policy is opened up between you and the carrier, there's nobody in between. You simply just go online and you can ask for access to your money. Remember what I said earlier. Who benefits from having access? The owner benefits from having access to your bank, to your access to my own money. I am operating just like the bank. I know I'm giving you a handful. I'm giving you a handful today, but I get excited when I happen to think about all the opportunities out here available for all of us to level up. It's our time. It's our time. Because if we can start thinking of ourselves just like institutions think of themselves, I think financial tools of the wealthy. And not all of us come from those wealthy families. Not everybody has that background. So we want to tell you a couple of things why. Life insurance has a few other things don't have. Meaning they're able to compound interest without taxes. Be able to put money away in policy loans against the insurance company's reserves. That's not your money. It's the reserves of the insurance company. I have the opportunity to take $90 out without any taxes. And I can use this money for whatever I want. Now, based on who designed and engineered these plans for you, that plan could be $50,000, $100,000, $200,000. So if I use a bigger number scenario, if I had $100,000 in it, I have access to 90% of my cash value that I could take a loan against at any time for any reason without any taxes. As long as I don't take a withdrawal, I need to take the loan. Are part of what I call the secret sauce, right? The second thing is I want to put out there is that life insurance is considered a tier 1 banking asset by banks. A tier 1 banking asset by banks. Why? Because it's saying that they will be willing to accept as collateral if you want to have loans against it. If you want to take a little money out and go to buy a startup company, if you place that you want to go for travel next year, hey, why don't you consider creating an emergency fund inside of your life insurance by overfunding the plan, right? And then when I take money out in the form of a loan, I have not disrupted the growth of my plan. I'm still qualified, or I'm still eligible for the dividends that it may be participating in. Typically 5.4% annual dividend that they pay out from a mutually held company. That can be for the rest of your life. It pays out on the accumulated amount of the asset. I don't know about y'all, but when it is sitting on your mattress, you're not earning tax-free money. You're not earning anything. And if you dug a hole outside and you stuck your money in it, guess what? It really does disappear on you. It's disintegrating right there in the ground. So get it out of the ground. Get it out from underneath your house. Get it out from underneath your bed, your pillowcases, and your pickle jars. Okay? It's time for us to elevate our way of thinking. Elevation is the key. Because if that's what you're doing, you're having a lights out. We want to turn your lights on. Absolutely. So take advantage of the fact that we can earn money from these accounts. I want to share with you the mindset that I want you to have. I want you to operational account. And an operational account in your mind, so that you're thinking just like the bank, this is your premium. This is your $100 or your $500 that you're going to put in above your policy. So your policy may be $600 total. $600 total. Well, in this illustration, you can see that we've put money into the policy, but guess what we can do? Once we put the money into the policy, we can take personal loans out for mortgages, auto loans, commercial loans, construction loans, equipment, credit lines, and much more. And see, if you really think about it, I don't know about you, but I have a daughter, and she always needs money. Send money for college. Why not consider having this as another opportunity to safeguard some emergency funds and still grow? If I have that $100,000 sitting in my account and I have access to $90,000, let's just say I had to pay $10,000 for whatever purpose. It doesn't even matter. I am still earning it. I'm still eligible to earn a dividend on the full $100,000, even though I've written a check for $10,000 out of it, because the insurance company is still holding the money that we naturally sent in. And they're allowing us to take loans against their reserves. Man, that is awesome. That I personally think that the insurance product is one of the most effective tools that we don't discuss. That we don't discuss at all. So someone asked me before, well, why doesn't everybody have one of these accounts if they're so effective? And I said to them, well, you have to be incentive for our government to talk about this product. There really is none. Why? Because when you make that decision to work with your insurance company, that is between you and the insurance carrier that you're working with. There is no middleman. So if you got the qualified plans such as the IRA, the 401k, 403b, 457, all those different programs. Those different programs, you have to pay taxes on the money that has been sitting there that hasn't been taxed. Why? Because it goes back to support our economy. You might want to look at it a different way. So, I just want to share with you guys why I thought that today will be a good day to share with you another, just like the banks do. I think it's purposeful. I think it's purposeful. If you knew that they're getting 5.4%, but you're getting less than 1%, wouldn't you want to have the same vehicle? Hey, listen, if you like this content and much, much more, do me a favor. Hit subscribe down at the bottom and let us know. We like to have you back. We like having your questions. And this came from someone that reached out to us from that wanted more information about how to start putting more money away for the emergency fund, for the rainy day. It is not an investment. Life insurance is not an investment. However, it is one of the tools that I like to recommend that you have as the platform before we start using the asset at all. Because I can always borrow from it my stocks and pay for student loans and so forth without instant. If you like the content, I want to say thank you for joining us today. And we've talked about how you can create your emergency fund using life. Don't forget to hit the subscribe button. Share with your friends. Catch us every Friday on this platform and the others, LinkedIn, Twitter, Facebook, and we want to hear from you. If you can take more of this content, we want to give you more to you. We want to provide you with more and more information. For joining us, we look forward to having you on Lifestyle Focus Wealth next time. This has been When the Lights Go Out. Are you ready? I'm your host, Ronco Johnson, and I look forward to seeing you at the top. See you next week, next Friday, different topic, same place, and we'll see you later. Bye-bye.